What's up, everybody? Today we're gonna be talking about my ideal system, and we're gonna just look at things from that perspective. I like to do this first. That's me. Just do this here. All right. So let's get into it. Yeah. I wanna make this fast and easy and very beginner friendly. So we're talking about my ideal system, crafting an ideal strategy, trading strategy. I believe this is something very important before you go out to search for a trading strategy. I'm gonna list a lot of things. I'd like you to just sit down and just follow through with me. Yeah. Aspects. This is the part of my strategy, so don't pay much attention to it. So aspects of my ideal system. I'd like the win rate to be between 55 to 66%. The trade distribution in a week to have 3 trades per week. This is the risk to reward in terms of that. This is a fixed R system, meaning we always risk 1% to make a fixed percent, which is going to be 3%, sorry. And then maximum risk per trade is going to be 1%. The expectancy per trade is not here because I'm still backtesting and I'm going to be having that later. My weekly EP, expected performance, would like it to be 5%, and monthly EP would be 20%. Now, before we get into a lot of things, I'd like us to do a two-system comparison. Yeah. Before that, I'd like to talk about high risk to reward strategies that have a low win rate. I believe the reason why strategies that have high risk to reward were created were for this reason, right? People didn't have a lot of money back then. I mean, I don't have money. I don't know about you. You might have money. You might have a lot of money. But back then, people did not have money. And so, they came up with a way to take the little that they had and multiply it at a very fast rate. And this is where high RR, low strike rate strategies were born, right? So in terms of risk to reward for this system, you get a 1 to 10, meaning whatever you're risking, you're making 10 times more of that. Yeah, sometimes it's even higher. Sometimes I come from a strategy like this. Previously I was trading a strategy that on average, meaning minimum, would be 1 to 10. The maximum I saw that I actually hit TP off was 1 to 36. Right, so I risked 1% to make 36%. So I risked whatever I was risking, and I made 36 times more of that. But it has a low win rate. So you win you have a low win rate of 30 to 40%. So let's say you have the 35%, or let's say you have a 40% win rate. You're going to, in 10 trades, you're guaranteed to lose 6 trades and win 4. That's guaranteed to happen. But we don't know which trade is going to come first. We don't know if this trade is going to be a loser or a winner. We know that in 10 trades, you are not going to get 6 losers straight back and then 4 winners straight back. Impossible. Because in trading, we have something called random distribution. And it is highly important to know this. Yeah? Now let's look at long-term profitability insights of this system. Large winners cover many small losses. True thing, I'm not gonna lie. The system I was trading took a lot of losses, but because the one trade that I'd get right was so big, those losses felt like nothing. This system gets into drawdown like crazy. That's also something you need to take note of, right? It has a high expectancy if all multiples are calculated correctly. Yeah. It takes less frequent trades because it has lower exposure. I remember I would not take a trade for 3 months straight, an entire quarter of the year, no trade, because I've built criteria so that I can siphon out all of these losses. I can have a high probability of not taking them, because a low strike rate strategies has a lot of criteria so that we can elevate that win rate. It means neglecting a lot of trades too. So less frequent trades means less exposure, which is a good thing in trading. The less exposure you have to the markets, the more we're safeguarding your capital. But you also need to realize that if you are trading M5 time frame, meaning you're trading the 5 minute time frame, you are not going to sit for 1 week without taking a trade on your hands. If we're saying you're taking 10 trades in a day, which is possible, there's a lot of people who take 10 trades in a day. If you are taking 10 trades in a day, you're telling me that you won't trade for an entire week and you're not going to take 50 trades that week. Impossible. So we also need to understand that psychology also makes up your edge. An edge is probabilistic governance we have over the market. That's as best as I can simplify it. What are the downsides of this strategy? Well, it can feel psychologically challenging due to frequent small losses. Right, listen to this, listen to this. If you are trading a $2 million account, pretty reasonable. You can get access to 2 million, guys. It's doable now. And you said, I can't afford to lose 10%. A lot of people will say, okay, if we're looking at it from a percentage gain or percentage perspective, I can't afford to lose 10%. It's okay. If I said 10% of 2 million is $200,000, and you said I can't afford to lose $200,000, that's just a no-go for me. I'm gonna start feeling nervous. I'm gonna start having fear. I'm gonna start having hesitation, and I'm gonna get into that. Your system's drawdown, or your system's worst case losing streak. Yeah, that's the one. Your system's worst case losing streak was a 25%. Was a 25% loss. You, my friend, are not guaranteed to lose 200,000. That's nothing. You are guaranteed to lose 500,000. But you say that you can't afford to lose 200,000. So when you have gone over 200,000 and you're now down 500,000, this is when your system naturally picks up again because it's faced this worst case losing streak. It's gonna naturally pick up again. But now you're afraid and you hesitate and you don't take the trade and it ends up being a winner. And then another trade presents itself and you take that one, you're like, oh damn, I didn't take that last trade, but it was a winner. Now I'm gonna take this trade because I know, because we don't know why you know, but you know. And that trade loses. Now your system is taking more added losing streaks. Like I said, your ability to psychologically trade a system is also part of that system's edge. Yeah? It's also part of that system's edge, right? So this system's another downside is that it requires strong discipline and a very strict risk management. Highly important because this strategy takes a lot of losses. Like I said, trust me, this is coming from a person who's coming out from a high low strike rate system. I still have screenshots of it, yeah, of all of the strike rates I'd get, of the TPs I'd hit. And mate, I'm not gonna lie, it felt nice. It felt nice to hit those take profits. Those take profits feel so nice to hit and they are so addictive, but the losses, that's nothing. That's nothing. Alright, let's go into low RR high strike rate system. Yeah? So, risk to reward wise, you're making 1 to 2 R on an individual trade, or 1 to 3 R. Meaning, if I'm risking whatever I got, I'm making twice of that or 3 times of that. This system has a high win rate, typically ranging between 60% to 80%. Yeah, let's say you had a 70% win rate and a 1 to 2 R strategy, fixed. Yeah, you take 10 trades. 3 trades are most likely going to lose, guaranteed. 7 trades are most likely going to win, guaranteed. The reason I start with losing trades is to emphasize, it's the emphasis that any strategy on the face of the planet is going to lose. It goes to losses. If you see a trader online that says, I have a 100% strategy, run away. 100% win rate strategy, run away. In terms of percentage growth, saying this strategy made 284% in a year, that's a good strategy. That strategy did good. But that doesn't mean that strategy did not take losses. Right? So you have a 1 to 2R fixed system. You won 7 trades, you lost 3 of them. You've made 14% in profit, 14%. You've lost 3%, so your net profit is 11%. So the high RR strategy, even though it loses more, you need more trades to just make one winning trade of time. In retrospect, that seems bad, but trust me, it's gonna get better. It's gonna get better. So frequent small wins, which feels more consistent. It is easier psychologically to trade that system, and it is also good for confidence. The more you win, the more you trust the process, the more you take losses. The more you win, the more you trust the system. And when you take losses, you can then have that factor to say, oh, but this system, I've been winning with it quite a lot, so I need to take this because I know it wins, so that I can take these. I'll lose, yes, every system does lose, but at the end I'll win because I've seen the wins, I've made profit from it, and that's that. Yeah. This strategy can compound steadily over time. Important. Compound steadily over time. You're gonna see it. I made everything for this video, guys. Right? The downsides of this is large losing streaks can eat into profit if there aren't proper risk protocols in place. As a trader, a strategy is a set of rules from step 1 to step X that leads you to an executed trade. A system is a set of strategies with rules. So a risk management strategy, a psychological introspection strategy, an ASR strategy, and then the ideal strategy, the trading strategy. But if you don't have proper risk protocols in place, if you're trading a low RR strategy, losing streaks are gonna eat you bad. But I'm gonna later on in the video, I'm gonna talk about how we can do that and try to limit our losing streaks. My purpose for this video, if I'm being honest, is to take you away from the thinking that the high RR low strike rate system works best, because it doesn't. And I come from experience trading a high RR low strike rate system for 2 years. I'm unprofitable. I'm part of the 99% of traders that lose money consistently. Right? Like we spoke, this system needs more trade to achieve the same long-term gain as the high RR system. Right? Moving forward, this is a 2-system equity curve over a decade. So this is for 10 years. System A is the low RR high strike rate system. System B is the high RR low strike rate system. When we said system A can compound steadily over time, this is what we meant. This line is system A. You have been making consistent gains for the past 10 years that if we're zooming out and not looking at it per week, per month, we're zooming out and we're looking at it based on years, your performance is just skyrocketing. Yeah? Look at system B, the system that makes a lot of money and loses a lot too. We arrived at the same point, so we have the same target. At the start, system B went into drawdown immediately. Before we even made any profits, we were already losing for an entire year, because I'm determining this is the median between these two intervals, between 0 and 2. This might be the median. Yeah? System B lost money for 1 year straight. Now, I don't know about you, but Me as a trader, I can't even afford to lose for 1 month. That's just me psychologically. So a system that I know is guaranteed to lose for 2 months is not a system for me. I need to go again and look and refine and probably learn another system if refinement doesn't work. But we lost for 1 year with system B, which is bad. If we're losing for 1 year, you're gonna start seeing correlation between losses. You're gonna say loss 1 and loss 2, they had these two similar things. Loss 3 also has those similar things. Let me not do these things for trade 4, and you don't do them, and you somewhat win. But the things that you didn't do were the things necessary for you to win. But you now don't do them. And you start building correlation. You say, oh, I won because I didn't do 1, 2, 3. And that lets you a win. Let me just do 4, 5, 6 because I did 4, 5, 6 instead of 1, 2, 3, 4, 5, 6. I just did 4, 5, 6. And now you do 4, 5, 6. You build a system around 4, 5, 6. 4, 5, 6 is not based on analytical or data-driven insight. It's based on correlation, not something concrete. And then after the string of luck, which I guarantee you is gonna end, after that string of luck ends, you're gonna take more losses. You're gonna ask yourself, this system doesn't work. Why? Well, because you didn't do 1, 2, 3, but you did 4, 5, 6. It was 1, 2, 3 that made 4, 5, 6 the winning trade. That is why we have something called what was it? What was the thing called? I believe I can't really remember the name of it, but it's when I don't really remember. It might come back again for me. It's when the system is making 10% and you're making 8%. You are quite close to the system because what we're trying to do is close that gap, right? I don't really remember the name of it. It's something that hit me personally, so I relate to a lot of it, right? So yeah, the systems both end up at the same place, but system B is quite the rough journey here, where we have equity height, and then we go into drawdown, and then we form another equity height. Equity height. This is the highest point, not overall, of course not. This is the highest point from this line going left, and then we go back into drawdown, and we make another equity height. Go back into drawdown, equity high. I can guarantee you one thing is gonna go back into drawdown and another equity high, and so on and so on. This strategy, system B, psychologically is going to be difficult. System A just kicked off to the moon, and system B started off on a bad note, literally. But we reached the same thing. You might be like, well, I'm gonna build proper risk protocols around system B, and yeah, I'll take advantage of the equity height where we're overperforming system A. Yeah, we are over. System B does overperform system A twice. It underperformed it 5 times. Even when you made your equity high here, you're still underperforming system A. But who cares, right? I mean, system A needs a lot of trades to reach system B's one trade. Who cares? Let's do a performance comparison, right? I want us to talk real numbers. Sorry about that. Okay, ChatGPT built this, yeah? So, yeah. System A is the low or high strike rate system. Okay, using the numbers you gave, which I gave ChatGPT, compounding 1% per week. No drawdowns for 4 years. So both of these data sets have no drawdowns, meaning we took no losses. We were making equity highs all the way. and I gave this thing a win rate, both of them. Yeah. So no drawdown for 4 years. I ran the exact math. We're starting with $2 million weekly compound return. This system makes only 1% in a week. That's what you need to know. It makes 1% in a week, meaning 4% in a month. In 10 months, you made 40%. In 10 years, you made 400%. System Beast does a lot more than that, right? So weeks are 52 times 4, which is 208 weeks. The final balance after 4 years, compounding weekly, is $15,844,398, rounded to the nearest dollar. Total profits made in 4 years is $13,844,398. We don't really need to know about how much we multiply this thing. I don't care about that. Let's go into system B, which is the high low strike rate system. Starting with $2 million, 12 trade cadence is 12 trades per year, because like we said, less frequent trades, which is a good thing for system A because it's less exposure. So you're taking 1 trade per month. Damn. Imagine if that 1 trade is a loss. That's why we said system B, system A, system B, the high low strike rate system, is harder psychologically. Yeah, we have 48 total trades, okay, with a win rate of 34%. Risk to reward is fixed, so it's a 1 to 10. A losing trade is minus 1% of the account, and a winning trade is plus 10%, right? And the trades is compounded, so each winning trade we compound, or each losing trade we compound. So we reduce our position size when we lose, and we increase our position size when we win, right? Using expected per trade multiplier, which is a probabilistic expectation. There were 2 methods here. This was the one with the highest return, so I chose this one. Yeah, and you multiply all of that. You don't need to know any of this equation. You multiply all of that. The final balance is $7,320,301. Total net profit is $5,320,301. Meaning you're making 38.32% per year. Now what happened here? I thought system B was winning way better. Same duration, but we're making 1% here. System A, we're making 1%. We're making 10%. How come we have 15 million and 7 million? This is what I wanted to sell to you guys. This is the thing I wanted you to realize. System B is gonna take a lot of losses because it has such a small win rate. You're gonna filter out a lot of trades, and you're gonna take a lot less trades than system A. And because we're taking a lot less trades, at the end of 4 years, you've made 7 million. And we have to realize that system A made twice of that of system B. This is what I wanted to sell to you, is that given the same duration, and I want you to be genuine, why not? I did not make this into 1 year, because if it was 1 year, this system would have overperformed this drastically. Take trading as a career. You don't want to study to be a doctor so that you can be a doctor for 6 months, and then if you really didn't perform well, you quit. No, you train to be a doctor for 4 years in university, then you have to practice for 3 years. That's 7 years total. But the same duration that your friends will go through to learn to be a doctor, which is university, you, out of that 4 years, would be better than them, because you'd have 7 million to your name. or you can have 15 million to your name. What I wanted to drive home is this: when we add years to system A, this system will outperform system B by a long shot. If I were to do the same exact math for 10 years, that amount, that 15 million would be nothing. This system would be making billions, and this one would start making tens of millions. Imagine if you're trading a $20 million account, you'd be making 158 million in a year, in 4 years. $158 million in 4 years, and you would have made 73 million. You, my guy, are rich with 73 million. I wanted to actually look at this and make this example because when I speak about percentages, a lot of you will still hold system B to your hearts. But when we look at dollar amounts and the return after 4 years, not 1 year, not 6 months, no, years, because that's what you should be aiming for. I've been trading for 2 years and I'm losing money, and I've just came across this idea, across this mindset shift that said, yo, you don't have to have the highest RR strategy in the world. You're gonna have the lowest and still outperform the guy with the highest. Because let's be honest, a strategy that makes 300% in a trade is useless if you're gonna lose 600% next in the next upcoming trades. Extremely useless. It's extremely useless. Let's be honest. Yeah? It's extremely useless. You're gonna need a lot of protocols for that system. So I wanted to drive home this fact, is that you, given multiple years, will outperform a person with system B if you're utilizing system A. But yo, don't take it from me. Yeah? Don't take it from me. I'm building system A. You go build system B. No, starting now, we go build system B. You follow this, you follow along. At the end of it, you'll know how to build a good strategy with both system A and both system B. Okay, mostly it was curated for system A, but I'll try to speak about system B. You go make a strategy for system B, I'll go make a strategy for system A. And then I believe it's gonna be 2029, which is 4 years. Okay, let's say 2030. I'll come again and make a video. I want you guys who's gonna be watching this video in the comments, tell me how much you've made. I don't like to speak about dollar amounts, but tell me how much you've made. Now this is my ideal system expected performance over the course of the year. Do not mind these accuracy growth in terms of percentages. They are not realistic. ChatGPT is slightly underperformed here. This system should be above 250% for an entire day. So win rate is 66.7%. 3 trades per week, 2 winners, 1 loser. Yeah? 1% risk per trade, fixed R of 1 to 3R. Net weekly profit is 5%. Now, I'm going to introduce something no other trader in the industry is going to tell you. This is your strategy's expected performance. This is what we use, this is what I'm going to be using to measure my success in trading over the course of a year. Looking at this, I want 3 trades. I want 2 of them to be winners and 1 of them to be a loser. Why? It means that I am up 5% for the week. But listen to this. If I have 2 winners back to back and I haven't taken the 3rd trade, I'm up 6%. I'm slightly above expected performance, which is good. I don't want the 3rd trade to be a winner, but there is probability that it might be a winner. What I'm going to do then is I'm going to reduce my size. I'm no longer risking 1%, I'm going to risk 0.33%. Yeah? Meaning if I win, I'm up 1%. Because the range that I should be above my expected performance is 2%. Meaning I should be above it by 2%. If it's 3, that's bad. That's bad for me. I know there's gonna be people saying, "What the fuck is this guy saying? What do you mean being up more money is bad?" Listen, this line, this line does not have a winning streak, does not have a losing streak, and this line makes 250% in a year. If I deviate from this line and go higher like this, then trust me, I'm gonna go lower than that. My job is not to get excited when I'm winning. My job is to stay within expected return. My job as a trader is to ping around this line by a factor of 2. Meaning if I'm below it, I'm below it by 2%. If I'm above it, I'm above it by 2%. That is why I have a risk protocol that says if we took 2 trades and both of them are winners, risk 0.33. When I lose that trade, good. I'm up what? 5 point what? 5.1. I'm up. I don't really want to do the math. I'm up 5 point something percent for that week, which is within expected performance. So I wanted to show you this. You can't build a expected performance for system B because system B has a lot of variant. Because we can't say each and every week system B is going to make 10% because there's a lot of trades that are going to get missed. But if we're taking one trade per month, we can say that system B theoretically should be making a 120% gain in a year. So you will measure your success based on a monthly interval. So that this would be January, February, March, April, May, June, July, and so on and so on. So for January you should be up 10%. But let's say you've lost January. That's just it, and you're down 3%. But for February, you made 20%. You take 2 winning trades, and now you are up what 17%. You are with an expected performance, but looking at it, you started like this. It's a V-shaped reaction. But hey, who cares? Now this is the part where I'm going to be trying to teach you guys how to build a strategy. Right? And I believe you should start with a simplified system. Don't try to learn everything at once. That's the biggest mistake. The rabbit hole of trading, especially for knowledge, is big. So don't try to learn everything at once. Focus on one core strategy that's easy to understand, like order flow. This is the strategy I'm trading. Order flow, I'm trading it differently from others. But you can trade a different strategy. You can trade supply and demand. You can trade something else. And what you want to do is break it down. You learn the building blocks. You know, identifying entries, exits, risk management, and market context. You know. Also, I break it down because there's concepts that a main strategy is built around. For me, order flow. I'd go and learn market structure, how to identify a trend transition, which phase of a trend we're in, a trend through multiple time frames. All of these things. I'd go and learn swing structures, and identify swing high, swing low, identify trading range. I'd go learn order flow, types of order flow, and add all of those together. If my market structure is 100%, and my identification of swing structure is 100%, and my identification of order flow zones is 100%, then you best believe that is one robust system. That system has a high probability of winning than it has of losing. So go back and learn this. But also realize that a system that wins a lot but has bad risk management is a losing system. You need to go and learn all of these building blocks. Yeah? Don't trade order flow. Why? You don't even know what order flow is. If you were to go and search order flow, you'd see something else. This is not the order flow I'm trading. Yeah? Go trade supply and demand. Go learn candle range theory. The power of tree, accumulation, manipulation, distribution. ICT, SMC, price action. Go learn all of these things. Price action really does give a good risk to reward ratio. Go learn Falcon system, Falcon FX system. Also gives a good risk to reward ratio system, go learn chart patterns, flags make a lot of money, especially if you are in a good pair that is most likely known for its perfect market structure creation. For if we're bearish, we got perfect lower lows, lower highs, lower lows, lower highs, all of those, and a perfect transition, not a lot of big guys. Yeah, that's a good one for you. You need to practice each part separately before combining them. Like I said, if I'm good in identifying what part of a trend we're in, and I'm good in identifying my swing structure and order flow zones, I have a very killer system. Pairing that with risk management and a lot of protocols, which we're going to get in, I have a flipping based system. Right. Another thing is you need to learn by doing. You need to backtest on historical charts to see how the strategy works. Also, this is where you gain a lot of things, a lot of insights about that strategy, drawdowns, a lot of things. You know, for me, I'm looking for a fixed 1 to 3 R, but through backtesting, I'm seeing that on average, I'm getting a 1.5 R, meaning I'm risking 1% to make 1.5%. That's not a good thing, but I'm utilizing depth of mitigation to try and filter that. When I utilize depth of mitigation, I do get better R, and I do get that 1 to 3. So you don't even know what depth of mitigation is. It's okay. That's for me, not for you to know. That's for you. That's for you not to know. No. Go learn a system. That's just it. Backtest it on historical charts to see how that system works and how that strategy works. Okay, let me be honest. A system is not a strategy, and a strategy is not a system. So yeah. Go learn a strategy. Backtest that strategy on historical data to see how it works. And then when you know how it works, simulate trades on paper or in a trade or in a demo account. Sorry, in a demo account. So on paper you might simulate with less money. Say if you're in the US, you might maybe trade $100, or you might maybe if you're in South Africa, you might trade 100 rands. Or demo account. Well, if you are looking to go into prop firms, which like I am, you might go straight. You might go straight for the prop firm account you want to trade at the end, which is your end goal. So for me, the prop firm account I want to trade is 2 million. So I don't have to trade $100. I can go straight for $2 million and see do I make money consistently with that account. Because that account, I'm taking that same model and applying it on a real one, and that's how I make money. That's how we essentially make money. Another thing is you need to refine through observations. Keep a journal of patterns you see, mistakes, and winning setups. This is going to be correlation. What is the correlation between winning setups? What is the correlation between losing setups? Like I said, a strategy you can't execute perfectly because you got psychological barriers that are hindering your success is a strategy you will lose money with. Important. So you need to journal these things. You know? And also you need to notice recurring market behaviors. Like for me, how price reacts to order flows. This is highly important. Um, you won't notice recurring market behaviors if you trade 20 pairs at once. So if you're trading Euro USD, USD JPY, USD CAD, USD CHF, USD something else, I don't know, and you're trading GBP USD, NZD USD, AUD USD, Euro NZD, GBP NZD, AUD NZD, 20 pairs, you're not going to notice market behavior that repeat on end. For me, I want to trade two trades. I want to trade two instruments. And I don't even want to trade two instruments. I want to trade one. Before the regime shifted of AUD USD, AUD USD was the trade I was mainly going to trade. Because through backtesting, it showed me the things I wanted to see. A trade distribution of 3 trades per week. It showed me that. Yeah. And we actually were hitting our monthly EP. We were making 20% in a month. We were slightly underperforming on a weekly basis. We were making 3%. We made 3% the first week under EP, which was the EP of 5%. And we too overperformed. We made 11%, which we were supposed to make 10%. Week 3 we made 17%, which we were supposed to make 15%, and then week 4 we made 20%. I'm not saying that we went from, I'm saying that when we're adding all of them out, week 1 we had 3%, week 1 plus week 2 we had 11%, week 1 week 2 plus week 3 we had 17%, week 1 week 2 week 3 and week 4 we had 20%. Was a good thing. And then Donald Trump went into office, the regime of AUD USD shifted. What is a regime? A regime is how the market of that instrument moves. Another thing, another homework for you before learning a strategy, go and learn that strategy. If that strategy is highly dependent on market structure, go and research pair characteristics because it's highly important. Ouch. Okay, 2 is your, okay, this is for me, right? Your learning path, which is my order flow strategy. My strategy started with simple market structure. I added order flow and I practiced for weeks until I had confidence. Now I trade a clear plan, simple, simplified entries, and solid risk management. I'm still going to solidify all of these things. And the key takeaway here is you need to pick a strategy. You need to learn step by step, and you need to backtest. You need to practice and refine that strategy, because your confidence comes from understanding, not from complexity. That's important. Backtesting and data gathering. 1, you need to collect data systematically. I'm not saying go and backtest 10 trades. No. The goal here is to have 100 trades backtested in order for us to understand performance and patterns. Yeah? And we also need to focus on attracting consistent wins. That doesn't mean we need to neglect trades that lose. Important too. We need to monitor conditions and outcomes. Yeah? We need to track entry conditions, mistakes, and trade outcomes. And we need to, because what this does is it helps us identify what works and what doesn't. Yeah? Like I said, psychology is also part of an edge. It's part of the strategy. You need to check alignment with your psychology, because testing isn't just about numbers. It's also about your mind and how you can perfectly trade that strategy. Make sure your strategy fits your mental approach and comfort with risk. Important, like I said, if you can't afford to lose 200,000 on a $2 million account and the strategy is deemed to lose 500,000, that strategy is not good for you, right? And this is my current phase, because I am still actively backtesting my strategy, and in this phase it's all about learning, observing, and refining. Like I said, I don't get 1 to 3, which is what I'd like to get, because it's my ideal system that gets 1 to 3. I get 1 to 1.5. I get 1 to 1.5. What am I doing to get that 1 to 3? I'm utilizing DOM, depth of mitigation. Yeah. And the key take here of backtesting is this. Yeah. Testing is where theory meets reality. So we need to collect, observe, and see if your strategy works for you, both mentally and technically. Because we're utilizing technical analysis, you understand this when you learn about market structure. Right? And that's where I'm currently at. My backtesting journey continues. Now we get into my favorite topic, data analysis. A lot of people don't really talk about this. Data analysis. Data analysis is a huge subject on its own, especially in terms of trading. It's a lot. Utilizing samples, out of sample. Okay, this is not it. This is system building. But for data analysis, there's a lot too. I'm trying to look up for standard deviations, and there's also something called expectancy per trade, which is a win rate on an individual trade. So if I don't want to go into much, let's go into this. So you need to review every trade, look at entries, you look at exits, and you look at outcomes. Highly important, because data never lies, but your mind sometimes does. And this is where discretionary trading and systematic trading come into comparison, where discretionary trading Sometimes you don't make a lot because you're based on observations that weren't um, turned into rules. And systematic trading is observations that we turned into rules that bred systems. Systematic trading will always beat discretionary trading if done correctly, but discretionary trading will always beat systematic trading if done correctly. Because there's a lot of discretionary traders that make a lot of money than systematic traders. There's a lot of systematic traders that make money more than discretionary traders. So it's highly important to know the difference between the two. Two, you need to identify what works. You need to find your highest probable setups. Right? Here it says you need to find your highest probability setups and zones. When I say zones, it's talking in reference for me, order flow zones. And you need to build a case study around it. Right? You need to research that. What was the analysis process? What were the market conditions? What was maybe the volume? Who were involved? What type of institutional interest was there? What type of market direction were we in? Was it a correction? Were we impulsing? Was it a news event? You need to build a case study on that, and then find as much knowledge around that one setup as you can. And once you found it, take that knowledge, make rules from it, and see if they work. What you want to do is take those rules, go back, test it again, go back, test those rules, and this is where in sample and out of sample works. Yes, this is where that works, right? You also need to spot recurring patterns that produce consistent wins. Like I said, go find your highest probability setups and make a case study of that. Even zones. For me, it's gonna be zones. I'm gonna make case studies of that. I have 3 zones, variants of order flow zones. There's a mitigated zone and an unmitigated, and when the entire leg is an order flow zone. That's for me. Don't worry about that. You don't need to concern yourself. Third is you need to eliminate what doesn't work. Remove setups or rules that consistently fail, right? And you also need to simplify your system to focus on the most profitable elements. Yeah. So go make a case study of your best winning trade. Go make a case study of your worst losing trade. Look at what the things, the market conditions, the whatever, the things I spoke about there. I can't really remember all of them. But look at all of those things. Yeah. This is where example reading is our example. I should be talking about this, but I don't want to. Look at them, and then see on your worst losing trade. Take those criteria. You've made rules for that. Take those rules and see if they apply to the losing trades, other losing trades. Maybe not the worst, but other losing trades. If they do, and the result, and because they are losing trades, and those rules do apply here, rules made from a losing trade should apply to a losing trade. If they do apply that, you need to eliminate those rules, because those rules consistently give you trades that lose. And if rules of a winning trade applied on winning trades work, then those rules will be the ones that give you wins consistently. You need to simplify your system to focus on the most profitable elements. Yeah. Yeah. You also need to calculate probabilities. You need to determine your win rates per setup and overall, because a setup has a probabilistic win rate. Maybe your setup has a 70% win rate. You can go much more. You can go heavy on that position. You can go with maybe 10%. That's crazy. Risk management, but you can go 10%. You have a 70% of winning. I want to emphasize the 30% loss rate. Then you have a 30% of losing. Though the chances of winning are high, the chances of losing are still there, right? So it's important to know your win rate per setup and overall, because it helps you make decisions based on numbers, not feelings. Also important. And the key takeaway here is that data analysis turns experience into knowledge. Yeah? Let the numbers guide you. Find what works, cut what doesn't, and keep refining. Importantly, system building, turning data into a structured system. Important. This is where you do most of the work. From raw data to rules. Review your results and define clear rules for entries, exits, and risk. Add filters to avoid weak setups. Maybe trades you've taken in the Asian session lose, or maybe trades you've taken on the first Friday of the month lose. These are filters. So now you can say, I don't take trades when it's the Asian session, and I don't take trades on the first Friday of the month. Nobody should be taking trades on the first Friday of the month because that's NFP. But okay. You also need to version your system. Create system V1, V2, etc. as you refine it. Important. Backtesting is a tedious process. That's why I'm still backtesting now. It's very tedious. I'm not gonna lie. I've added a new protocol, and that protocol saved me from a lot of losses. And yeah, now I started backtesting another pair because the regime checked a lot of it. Right. Each version reflects improvements and learnings. Important. Clarity is key. I wanna emphasize this one. Your system should be so clear that anyone can trade it. You need to have rules so simple that even I, a beginner, not knowing what the hell ICT is, if you made an ICT strategy, your rules should be so clear that when I follow them, I make money based on probability of this. So if you have a low win rate, of course we'll know I'm gonna lose more than I win. But if you have a high win rate, I'm gonna make money, guaranteed, right? Because simplicity beats complexity. It is important. Okay, this one is beyond the basics. This is optional. You don't really need to know. This is for advanced traders. This is for people like me. No, because professionals utilize something called Monte Carlo simulations, Platino matrix, Sharpe ratio, in sample versus out of sample testing, and these validate robustness, but really aren't necessary for you guys as beginners. Monte Carlo is something I'm going to utilize very much. Platino too. Sharpe ratio is important. In sample and out of sample. Yeah, well, go learn that. Go learn that, guys. You can't get it all. You can't be spoon fed. You have to want this. And the key takeaway here is this. System building is where data becomes a repeatable, structured trading plan. Right? And you need to make it clear. You need to make it testable. And you need to make it version. Because clarity, that's our edge, all of us. The clearer we understand the strategy, the more we're gonna win. Protocols and risk management. You need to define your protocols. What is a protocol? A protocol is essentially how you respond to different outcomes in trading. Yeah. Go learn about gambler's fallacy, and you'll see why you need protocols in place. Go learn about it. For an example of what a protocol could be, after a loss streak, meaning multiple losses on end, back to back, meaning the first trade is a loss, second trade is a loss, third trade is a loss, fourth trade is a loss, fifth trade is a loss, and so on and so on. Maybe your protocol is to pause, stop trading, review those losses, and then adjust. You might be adjusting your position size, meaning reducing risk. You no longer risk. How much is it? No longer risk 1%. For an example, let me do an example. Let me say the worst case Monte Carlo simulation scenario is 10 losing trades in 4 weeks, but all of them were 3. That would mean so 12 losing trades. Yeah, 12 losing trades. This is how I'd approach it. So because I know that the worst case losing streak Monte Carlo simulation is 12% drawdown, 12% losing trades back to back in a month. All of them had 3 trades. All of them losers, 3 trades losers, 3 trades losers. All of my Monte Carlo simulations. I can then deduce down to say, if we get 3 back-to-back losers, I'm in a losing streak. So this is what I do. I take 3 losing trades. The next week, I'm reducing position size to 0.33. Yeah, and when I lose those 3 trades, I'm down 1%, 1%, 1%. So totally, I would be down 6%. Understanding that in a week I'm supposed to make 5%, you can see how quickly I get out of drawdown than if I had been risking 1%, I'd be down 12% and I'd have to make 12%. And it would take 3 profitable weeks to go to break even. It's not really nice. Yeah, but that's a protocol I'm currently building. Of course, you need to test that protocol as well. You don't just build protocol. You also need to go test them out, utilizing, like I said, Monte Carlo simulations. Like I said, Monte Carlo is a complex topic. Don't worry about those guys. Okay, you need to set limits and controls. Right? You need to have a daily max loss, meaning in a day I'm only allowed to lose this much. I hate the fact that it speaks of loss. It should be a daily, yeah, max loss. Meaning you can. I like to use percentages. Meaning in a day you are. Oh, for me in a day I'm only allowed to lose 1%. That's just it. In a week I'm only allowed to make 5%. Give me 7%. Yeah. I mean, give me 3%. Yeah. About those two, I don't want to. I don't want that. You need to set weekly drawdown limits. Maybe you can, yeah, you should do this, but of course there's going to be protocols, so there's going to be variations of this. You always use a fixed risk per trade of 1% or 2%. I don't know why you'd risk 2%, but whatever. You need to matrix your risk, meaning map different scenarios and then respond to them. How would you respond if the market was doing this? This is where Monte Carlo, this is what we use Monte Carlo on. This because Monte Carlo maps different scenarios. That's why I said worst case scenario and there's best case scenarios. For me, it might sound controversial, but I hate losing streaks. I hate losing for a long period of time, and I hate winning streaks, meaning I hate winning for a long period of time. Because like I showed you my expected performance, it doesn't have winning streaks, it doesn't have losing streaks. And I know if I make 1% for 4 years straight, 1% per week for 4 years straight, trading a $2 million account, I'm coming out 15 million. I'm not gonna lie, 15 million is a lot of money. I'd like 15 million to be honest. That's just it, I'd like 15 million. I don't know about you, but I like it. Because $5 million here in South Africa is 90 million rand. Yeah. I don't know about you, but 270 million rand. That's a lot of money. Right? You need to protect your account while staying in the game. If you go and research on YouTube Waka Asim, as in Asim, it's ASIM. Yes, Waka is WAQAR. Waka Asim. You search. Oh yeah, you search Titans of Tomorrow. The latest one, if he didn't publish another one, is Stop Chasing Profits, Chase Survival. I recommend you guys go watch that podcast. It's a very good one. And the takeaway here is risk management keeps you in the game long enough so you can win. Right? And trading is mostly about survival. Profits come off. Tracking routines and system review. You need to track every trade. You need to record reason for entry. What were the emotions you were feeling when you were in that trade? Yeah? What were the emotions you were feeling when you were in that trade? What's the outcome? Did I win? Did I lose? And you need to note all of these down and add your own notes, of course. Because this helps you identify patterns, strengths, and weaknesses. Maybe let's say you journaled 10 trades, and the losing trades you were either angry or sad. In the winning trades you weren't happy, you were just neutral. You can then say, whenever I'm angry or sad, I don't trade. That's a refinement that would have helped you avoid those losing trades. That's just it. That's how traders gain edge, probabilistic governance over the market. You have to have governance of your system and governance of yourself. Important. You need to have weekly and monthly review. You need to analyze results regularly to refine your system. And you need to look for recurring profitable setups and mistakes to avoid. But you also need to look for unprofitable setups and that analysis process you need to avoid by as much as you can. You also need to establish a routine because we have a pre-market routine or a pre-trade preparation, the things we do before we trade. So for me, it would be, because I'm still backtesting, I don't have this yet. But what it might look like is if you trade 9 a.m. the London session, you might want to sit down at maybe, let's say, 8:30 and do your chart mapping, market mapping, map out what trend are we in. If I'm speaking in order flow, I'll map out the trend, I'll map up my trading range and order flow zone, and then I'll set my alerts. Then 9 a.m. hits, I'm just waiting for price to do its thing, and I have a game plan now. When price does its thing, I'm not emotional, I'm just calm and composed. And then we have execution during trading. You might want to take your phone out of the room, your bedroom, if you're like me and you're in the bedroom. It's my bedroom, guys, you're gonna see more of it, a lot more. And then we have the post-market routine, which is the reflection and logic. Alright, the key takeaway here is this: consistency isn't just in your trades, it's in your routine, because they say we don't rise to the level of our goals, we fall to the level of our habits. And no, your habits make who you are. It is in your routine. Consistency is in your routine. If you are consistent with your routine and you're seeing good results with it, then continuing with your routines is most likely going to breed great results. But if you see that you don't have any routines and you're losing, well, continuing without having a routine, well, you shouldn't expect to win, because I believe it was Isaac Newton that said the definition of insanity is doing the same thing over and over again and expecting a different result. A different outcome or result doesn't matter. Same thing. Alright, the key takeaway, the key takeaway was that it's in your routines, so you need to track, you need to review, and you need to refine your system relentlessly, because small improvements every day lead to long-term success. Yeah? And with that, guys, I'd like to say thank you for tuning in and watching this video. I hope you enjoyed this presentation and you found value in it. And follow along, guys. From now on, I'll be sharing videos of my backtesting, my data analysis, and my system building. Like I said, I am crafting my ideal trading strategy, so it is imperative that I do this. And you'll see my ideal system in place. You'll see me building it, because what I teach is what I practice. Practice what you preach is what they say. And like I said before, if you found this helpful, please click like and subscribe to follow along, and stay tuned to see the full journey of building a trading system based on results. Guys, I'm gonna be honest with you, backtesting is tedious, it's very tiring, and it's very emotionally draining. So please bear with me. These videos are going to be coming out consistently, but you guys will see me from backtesting, data analysis, and system building, and you guys will see me go purchase a funded capital account of $5,000 and trading that and tossing it, and then making $1,000, and then purchasing a 200k account and then tossing that one, and then going to a $2 million account. That's when I'm leaving the YouTube space for good, because I don't like to be out there. So yeah, guys, stay tuned, and the key takeaway to all of this is really, guys, learning is best when you see it in action. Really, learning, like, you can't say, oh, I can't be here and be like, go do this exercise and craft your ideal strategy and your ideal system you will see that okay, what I spoke about in this video is what he's doing. And so you might have more um, willingness to just listen and do it. I know I'm a kid. I know I'm ugly. I know I'm black too. There's a lot of factors, but if you guys just learn from what I teach, you guys will see that this is for your own good. Because I'm teaching my own mistakes. Because I don't want you guys to go through it. I've been through the high RR trading strategy. I don't want you guys to go through it. So yeah, please guys follow along and see how a real system is built and refined step by step. I'm Guys, and I like to say thank you and goodbye.